Interest rates in Australia are on the rise once again. As the world goes through serious inflation, different countries are impacted differently. Since inflation is usually directly correlated to the interest rates, it appears that the economic situation in Australia is getting quite interesting. Let's have a look at how a sharp rise in interest rates means for the Australian economy right now and going forward. So, without further ado, let's get started. Let's start with the annual inflation rate, which is projected to go back above 5% by the end of the year. This may be bad news for people who are looking forward to lower interest rates. Rent, gas, food, and service prices have been going up, which has made buyers very worried. It is safe to say that the rising inflation is becoming a cause of concern for the Australian nationals as they witness price hikes across most commodities. Now, this is where the facts and figures come in. The Australian Bureau of Statistics just released data on monthly inflation. It showed that the Consumer Price Index went up by 5.2% over the previous 12 months, with August being the most recent month. Compared to July, when the rate was 4.9%, this is a big jump. This big change in inflation since April makes people worried that the price of essential goods and services will stay high for a long time, even though the prices of non-essential goods may be leveling off. The main thing that sped up this rise in inflation was the huge rise in the price of gasoline in August, when diesel wholesale prices averaged 26.6 cents per litre and unleaded prices averaged 17 cents per litre. In times like this, it's important to obtain takes by economists who are familiar with the country's economic landscape. Diana Musina, Deputy Chief Economist at AMP, is worried about the direction of inflation because there are more things now than there were a few months ago that are raising inflation threats. She said that this means there are now more things that are making price risks higher. She even said something that made it sound like the interest rate might go up again before the end of the year. By the way, we like to briefly pause here to request that if you like our videos, don't forget to show your appreciation by subscribing to our channel. Your support really matters to us. So, if you look at the monthly indicator, the annual rate of inflation in Australia hit its highest point of 8.4% in December 2022. Ms. Musina said that the current rate of 5.2% is still too high, going above the goal range of 2 to 3% set by the Reserve Bank of Australia, RBA. It seemed like the most likely time for the next rate hike would be in December, after the next set of quarterly figures on wages and inflation came out. This would happen after the data are made public. She did say, though, that it was likely that the RBA board would keep the cash rate the same at their next meeting. Since June, the RBA hasn't changed the way interest rates are set. However, it has been keeping a close eye on inflation and will continue to do so. Paul Bloxham, Chief Economist at HSBC, thinks that there is a chance of another rate hike before the end of the year. However, he also says that based on the most recent monthly CPI reading, there is no guarantee that there will be a hike in October. Even though the most recent reading on inflation shows some possible risks, it doesn't necessarily mean that rates will go up in October. ANZ, CBA, and EY experts all say there won't be a change in October. Paula Gatsby, a senior economist at EY, says that the RBA will be ready to pounce if output doesn't rise and prices for services keep going up. Even though there is still a small chance that the RBA will raise interest rates again, most market players think that they will stay where they are. On the other hand, NAB thinks that interest rates will go up one more time before the end of the year, most likely in November. The yearly rate of inflation dropped from 5.8% in July to 5.5% in August. This was because volatile goods like holiday travel, fuel, fruit, and veggies were taken out of the calculation. It looks like this means that inflation is moving in the right way, at least to some degree. A senior economist at PropTrack, Angus Moore, says that even though rising petrol prices helped make the headline inflation rates higher, the measure that takes out volatile costs, like gas, continued to go down. Because of this, it is very unlikely that this latest news will have a big effect on the RBA's view. The Reserve Bank of Australia's September rates meeting minutes said that rising petrol costs would cause inflation to rise. This choice was made after the cash rate stayed at 4.1% for 3 months in a row. On the other hand, the minutes showed that price hikes were expected to continue to slow down in the second half of 2023. Interestingly, after taking over from Philip Lowe on September 18, RBA Governor Michelle Bullock is about to make her first choice about the interest rate as governor. Such choices have a huge impact on the economic outlook of the country over the upcoming years. So, costs of housing went up by 6.6% over the course of the year. Costs of transportation went up by 7.4%. Cost of food and non-alcoholic drinks went up by 4.4%, and insurance and financial services grew by 8.8%. These were the main things that caused inflation. The housing group of the CPI basket, which includes rents and the cost of building new homes, Mr. Moore said, gives a confusing picture of the industry as a whole. It's been getting steadily slower for the prices of new homes to go up, even though rent prices have kept going up. Rents are going up quickly, which shows how competitive the rental market is right now. Housing is still one of the main things that causes inflation. Back in 2022, building prices went up by almost 20%. Now, they are finally starting to level off at their current level. Costs for making things are still about 5% higher than they were a year ago, but they don't make as much of an impact on inflation as they used to. Even though the supply of building materials has grown and the price of construction has stopped going up, many renters still can't make the switch from renting to buying a home because interest rates are going up and home prices are going up. The cost of housing has dropped to its lowest level in at least 30 years, making it harder for renters to buy their own home. PropTrack's Housing Affordability Index says that a family making the average income would have to save 20% of their income for almost 5.5 years in order to have enough money for a 20% down payment on a home that costs the new median price. In New South Wales, which has the highest housing prices, this time frame goes on for more than 7 years. Higher interest rates and problems in the construction business are still making it hard for the pipeline to get built. This is most likely the case because changes in interest rates have a big effect on the construction business. Also, the building industry has been having problems for the past few years, which has caused construction times to be longer and costs to go up. Since building costs have remained the same, it's possible that some of these problems are getting easier to deal with. However, it's still not clear how any of these things will change over the next few months. For similar content, feel free to have a look at some of the other videos on your screen. Until then, goodbye.